George Washington once wisely said, "Spread your blue chip investments." Actually, that's not true. But he did say we ought not to look back unless it is to derive useful lessons. And there's no doubt that when investing, it can be useful to look back and see which investments went well in order to learn lessons for the future. So today, we're going to look back at the top 5 best performing stocks that I held in 2021. Now, some of these on the list might just surprise you. So welcome back to the channel. I'm Mike Smith, a fund manager based in Sydney, Australia. 2021 was a big year for the world of investments. As countries slowly emerged from the COVID pandemic, Apple reached $3 trillion market cap, Facebook became Meta, and an army of Redditors fought back against hedge funds in the GameStop saga. But how did all that affect our investments? We're going to break down our top 5 best performing stocks in 2021. Starting with number 5 on our list, this one might surprise you as it did me when I was calculating these numbers, and that was Home Depot. With a price appreciation of 56% for the year, Home Depot performed more like a growth stock than a blue chip value holding. In fact, Home Depot was the best performer on the Dow Jones Industrial Average, an index that represents 30 large American companies that are chosen from most of the major sectors. To put it into perspective, the Dow was up about 19% in comparison. Now let's break down where their performance came from. A notable contribution to this 56% gain was an 11% rise in the days after their third quarter results, where they released in mid-November. Home Depot reported revenue of $36.8 billion and earnings per share of $3.92, beating forecasts of $35 billion and $3.40 respectively. Same-store sales climbed 6.1% above expectations of 2.2%. The average spend per customer on each trip increased by 13% to $82. So where did all this new demand come from? Firstly, Home Depot benefited from the work from home trends caused by the pandemic, as well as low mortgage rates and rising property values, which gave people more time and incentive to pursue the do-it-yourself projects on their homes. Secondly, although the well-noted supply chain issues hampered most consumer businesses, Home Depot was able to get around this stumbling block by chartering its own ships to transport goods to American stores. And finally, Home Depot expanded its digital business, which allowed customers to order products ahead of time before picking their purchases up at a Home Depot brick and mortar store, which showed how well management has adapted to the pandemic and provided a future growth pathway for both an online and physical store presence. Taking the 4th spot on our list was one that probably won't come as a surprise, and that was Pfizer. If you hadn't heard of Pfizer before 2021, you certainly have now. As one of the main manufacturers of COVID-19 vaccines, it's become a household name, and its share price boosted 60% over 2021. So why did it do so well? An early worry for investors was that once the vaccines had rolled out, that would be it and the value would plummet. However, one of the main reasons for Pfizer's sustained success, and not just a flash in the pan, was because investors realized that the need for continued boosters, variant-specific shots, and antiviral pills would ensure the ongoing value of Pfizer as an investment. The new pills in the pipeline have been a big boost. Pfizer's share price jumped over 10% on the 5th of November, when the company announced the results of its study of its antiviral pill Paxlovid. This pill was found to reduce the risk of hospitalizations and death by 89%, and they announced they would seek FDA approval. Furthermore, Pfizer went up 17% over the week of 9 of December as it received US FDA emergency use authorization for booster vaccines for adults. With the final results received for the efficiency of Paxlovid and the value accretive acquisition of clinical stage company Arena Pharmaceuticals, who focus on immune inflammatory diseases, Pfizer continues to grow as a top investment going into 2022. Now, coming in at number 3 was Atlassian, the software company behind collaboration mainstays Jira and Confluence, and also Trello. These names might not be commonplace for many, but Trello especially is making waves in everyday productivity sector. It's a collaboration and CRM platform we use every day in our business, and I plan to do a productivity video soon covering how I use Trello. So again, don't forget to subscribe so you don't miss that. And now, with the global shift towards working from home since the beginning of the pandemic becoming a feature that looks set to remain the new look of working life, the software to organize remote work has become more important than ever, and Atlassian has become the biggest beneficiaries of the work from home trend, with a share price increase of 63% in 2021, thanks to its collaboration softwares, as I mentioned, Jira and Confluence. and has also benefited from the shift to cloud and the need for data centers to fulfill new demand. When Atlassian announced their Q4 2021 results at the end of July, its share price jumped over 21%, strongly exceeding forecasts across the board. The announcements included revenues of $560 million and earnings per share of 24 cents, compared to expectations of only $425 million. That's a huge increase on expectations. They also added 23,000 net new customers, and Atlassian's focus on cloud-first approach has also resulted in more than a doubling of cloud migrations year on year, and they show no signs of stopping anytime soon. Going into 2022, Atlassian's share price jumped further 10% after announcing Q1 2022 results, once again beating all forecast expectations, including increase of 53% to cloud revenue and 68% to data center revenue, demonstrating how Atlassian is driving their growth based on the surging megatrends of cloud and data centers. However, along with the rest of the market, Atlassian's share price is obviously off from its peak after the big sell-off that we've seen throughout the first month of the year. But in saying that, there will come a time, and I believe that's happening now, where it's too attractive to ignore and the stock price is starting to come back up a bit. So keep that in mind. It may also be one of our top 3 investment picks for this year, 2022. So make sure you go back and take a look at our picks from last year where I tipped Apple, Google, and Microsoft. And basically, if you weren't in the large cap sector for 2021, there's a good chance you underperformed substantially. Now, getting back on track, it was very close, but our runner-up on the list was Alphabet, the holding company for Google. Alphabet had a record year on the share market, where Google L recorded the largest annual gain since 2009, with a 65% increase, by far the top performing big tech stock of 2021, with Microsoft next behind it at 51%. To put this into perspective, the Nasdaq 100 went up by 27% in comparison. So why did Alphabet do so well? A lot of it was off the back of strong fundamentals as customers used Google to search for more products and travel options, as well as spending more time on YouTube. In fact, YouTube saw the most significant growth of any social media platform throughout the year. Despite inflation concerns throughout 2021, Alphabet's advertising and cloud business were both well insulated from these pressures. Companies continued to buy ads even as other expenses they had increased, and they kept paying Google Cloud to keep their websites and apps online. Remote work provided further tailwinds to its cloud infrastructure unit, where Q3 results were announced at the end of October. They beat all expectations and the share price jumped 7%. They announced a 43% increase in advertising revenue to $53 billion and a similar percentage jump in YouTube ad sales to $7.2 billion. As the online space continues to grow and we spend more time online, Google looks set to have a very strong 2022. Again, the stock price is off with everything, but I don't see this lasting for an extended period. The opportunity will become too intense to ignore. Now we've come to our highest performer. Number 1 on the list was Nvidia. Standing head and shoulders above the rest of our list was Nvidia, which surged an extraordinary 125% in 2021, making it our top pick by far. So how did it happen? A lot of the gain came late in the year as the concept of the metaverse gained more traction. Investors became aware that Nvidia is set to become a key player in this new mega trend, and Nvidia shot up more than 50% in just September and October alone, a period leading up to when Facebook's name was officially changed to Meta platforms, and brought the concept of the metaverse to the forefront of public consciousness. The increased demand for computer components due to remote working also played a part, as Nvidia consistently beat earnings expectations throughout the year. Its share price increased 15% in the days after Q2 results were released in mid-August. Revenues of $6.5 billion and earnings of $1.04 were reported, beating expectations of about $6.3 billion and $1 per share, respectively. This bumper report showed how fast Nvidia continued to grow, with revenue up 68% year on year and its graphics segment growing 87% to $3.9 billion. Nvidia backed this up with Q3 results with both earnings and revenue beats, providing their consistency in outperforming. Investors reacted positively to these results and the share price was up 13% in the days following mid-November. The 50% increase in revenue was primarily driven by GPU sales and hyperscale customers such as Amazon, AWS, Microsoft Azure, and Google Cloud, as demand for high-powered graphics grows. Nvidia is set to continue to reap the rewards as a key player.